Hi guys, John deRoulet, Head of Revenue Management Education at Wheelhouse, and I'm here to do a data deep dive in the Palm Springs and Joshua Tree markets. Really excited to talk through a bunch of Wheelhouse short-term rental data, as well as some higher level data to help you guys get an idea of how to best treat your summer and what's going on around you in the market. Just so you know a little bit about me, I am the head of revenue management education at Wheelhouse. I've had the opportunity over the last 4 years with Wheelhouse to work with clients all over the world of all different sizes, from small SMB property managers to large institutional revenue management organizations. Prior to my time at Wheelhouse, I worked as a revenue management consultant and also spent 8 years as the head of revenue management at an organization called Stay Alfred, where we grew our portfolio to 3,000 units in 33 cities. So a lot of revenue management experience. I'm really excited to be able to talk to you about this today. We've been doing these regional town halls with people all over the country because we know that revenue management is tough, that people got a lot of money to make, and since COVID, things have been pretty volatile. So we're hoping that this data will help you out. Before we get started, I just wanted to let you know that we are going to primarily be using Wheelhouse data in this conversation. Wheelhouse is a dynamic pricing and revenue management platform, so we do everything from pricing analytics to suggesting prices, posting, controlling your mins, that kind of thing. But we also have a ton of great data tools. Today, we're going to be using the Wheelhouse Market Reports, which is a free tool for anyone. You do not have to be a Wheelhouse pricing customer. We're also going to be using our Wheelhouse Sets tool, which is another way to get market data rather than at top high-level trends. You can get all the way down into granular neighborhood and listing levels. That tool is partially free, partially paid. If you want that data to be kind of saved and aggregated and used across the platform, it is by subscription, but tons of that data is available for free just by logging in. The last thing I wanted to tell you about is Wheelhouse's new performance insights that are available for everyone for free. All you have to do is sign up with Wheelhouse and link your account. We've developed a great business intelligence tool that professional revenue managers use to monitor their pickup, their sales, their occupancy, compare that to the market, compare that to their own historicals, and we've decided to make this tool free for everyone. If you don't have a good tool to keep track of your revenue management or to be able to make decisions and see what's going on in the market, this is an excellent tool for you. If you need some help or some training and you'd like to schedule a free consultation, let us know. We'd love to show you how to use this tool, give you some insights from our in-house revenue managers, and set you up for success in 2025. All right, let's jump forward and start talking about the data. So before we dive into the specific Wheelhouse market data, when I do these, I like to look at just some top-level data and just see what's going on around us. I usually look at CVBs, I look at industry data sources, things like that, just to see what the general perspective is. And in my research, I wasn't able to find a ton around Palm Springs or the greater Palm Springs area, but there are some interesting tidbits out of Visit California's research that they're reporting on that's very, very recent. So you can see here that this was posted on May 2nd, 2025, and this is just an overview on the state and regional lodging forecast. Now, we'll kind of have to guess about how this kind of filters down into Palm Springs, but at the state level, the state is expecting a few things. One, a slight increase in room revenue across lodging, primarily driven by modest ADR growth. So as we've seen that inflation get built more and more into the economy, we see prices go up, and customers are going to be paying a little higher price, which obviously is going to come up through the ADR. Now, that being said, the state is expecting a decline in overall occupancy. So there is going to be pressure across California markets. They're saying that part of this is supply growth. We're seeing a lot of supply come online in the STR space where supply comes on faster. We've probably noticed that in a number of markets, huge explosions in listings and homes available over the last couple of years, and that's going to impact the overall statewide occupancy. In addition to that, the state is expecting a pretty significant decline in international arrivals, which are going to affect occupancy and demand, right? We can go a little deeper here because the Department of Commerce and Visit California also publish a specific kind of statewide expectation of international arrivals. Just in summary, they're seeing in March already, which is pretty cool that they've already posted March data. They've seen a decline of 11% in non-resident international arrivals through port of entry, which is a pretty big decrease. with Canada remaining the top international source by volume, with it also a bigger decrease than the overall average of international. So that's something to keep in mind, right? Pretty much every one of these international markets that they mentioned, Mexico being another big one, are seeing pretty significant decreases. Europe included, we're seeing sharp decreases in travel to California. If you in your portfolio have large international travel contingents, that could be a pretty significant impact for you. We can go just a little bit deeper here by looking at California's report on visitation and spend forecast. So this is going to give us some future years about how they expect things to happen. It also gives you a little bit of a vision about how much of that revenue in California travel is being made up of international, because we do know that that's expected to drop. And they do reiterate that here. They expect a little bit of growth on domestic tourism. So your California visitors are going to grow slightly. Sorry, let me rephrase that. The California visitors are going to decline slightly, but their spend is going to increase a little. That aligns with the idea that ADRs are going to go up a little, but we are seeing a slight decline in the expectation of California travel itself. And then that international visitation dropping pretty substantially. So really something to consider as you go back into your CRM and the sources of like where people are from. You know, are you collecting that data? If you're not collecting that data, can you use the zip codes on the credit cards you're collecting to get an idea of who is staying with you? And are those going to be traveler segments that really impact you, particularly if they're coming from Canada, Mexico, or Europe? You may have to be competing against that increased supply for a lot smaller pie. All right, so let's jump into some Wheelhouse data. So where I am right now is I am logged into Wheelhouse and I am on the market report. So you can see on the upper bar that we have a market segment. That allows you to access a market report for any market in the Wheelhouse portfolio. You do not have to be a paying customer to do this. Anyone can access this. So whether you're using Price Labs or Beyond or doing it yourself, you can go in and get some market data. And this is going to give us some high level trends. I have the Palm Springs market pulled up. And as you can see, the Palm Springs market's going to be pretty wide. That's going to include Joshua Tree, it's going to include Coachella, it's going to include Palm Springs, and we're looking at a pretty big market. Now that means we won't be able to get into super detailed performance for each of these market areas, but it does give us an idea of the overall trends, which is really helpful for contextualizing how we're talking to owners as we set our strategy going into the future months, that kind of thing. The first place I'm going to go when I'm here is I'm going to hit this trends button. And the trends are going to give us year over year, month over month statistics for each of these KPIs. And the place I like to start is adjusted occupancy, because occupancy is going to give us a good impression of how demand is doing, what the consumer is doing. Now, we do know that rates may be different underneath. We'll take another look at that. But at first, this occupancy perspective is going to be pretty helpful. Before we get started, I'm going to pull off 2023 and 2026, and we're just going to look at year over year. And already in Palm Springs, the trends are kind of interesting. Q1, we see January, February, we see a little bit of growth actually. Occupancy is a little higher. People are looking strong. This is actually something we've seen kind of consistent across a lot of markets, is that January itself was surprisingly strong and really gave good signals for the rest of the year. However, as we get into March and April, we see a little bit of a loss. Now, some of this may be caused because Easter moved. However, we're not seeing the full amount of what moved appear in April. So it can't just be accounted for Easter as well. We see a pretty substantial decrease in occupancy in March, starting to see those headwinds. As we look at booking window data, that probably would have been visible as early as January, but it would have been hard for people to see unless they had really good data available to them in their own portfolios for pacing, or at the market level if you're using data through a data partner. Now, April definitely stabilized quite a bit, which is a good thing, but it's not making up for this drop in March. And really the big question is, as we go into this kind of shoulder season across the summer, probably more of a shoulder for Joshua Tree, is are we going to continue to see the attrition in March, or are we going to stabilize a little bit around April? Now, if you recall, when we looked at some of those Canadian travel things, those things just started to occur in March. So that takes time for that to build into a market. Some of these international forecasts are probably going to have a future effect. And when we look forward in May, it looks like the pacing at the market level is okay, right? We're more than halfway there. There's not a super high market occupancy overall. And there's enough time to possibly get to an equivalent last year occupancy rate in the next 2 weeks. Now, we are running out of time in May. It is a lower season, so there probably is a short booking window. But one of those things to check is, the market itself seems to be pacing okay. How are you pacing? Because there's a chance that this isn't quite going to hit what it did last year, that the whole market as a whole is going to do worse. If that's the case, you really need to compare that to your own pacing. If you are doing better, you're probably in good shape. If you are doing worse than last year, you may need to be making some pretty big adjustments. And since we don't have much time left in May, that may be something you want to extrapolate forward in June, July, and August, right? These are not going to be the strongest seasons at the entire broad market level. There's not a lot on the books for the market, and we don't have a lot of time, which means if you're finding that you're pacing behind in May, or you found that April and March were a struggle for you, you may want to extrapolate some of that forward and really try to undercut the market a little bit further out, especially if you anticipate that you're going to have to compete for business in the short term. Now, another thing I like to look at is what the top performing listings are doing and just see if there's some differences in trends. And we see a few already. For one, the overall occupancies are much higher among the top performing listings in the market, which makes sense. We still see the January, February trend and March. We still see that attrition in March, although it's not that big. And we actually see some recovery of that in April. So that April performance was actually much stronger. When we look forward to May, there's a higher level of pacing among the top properties. When we look into June and July, there's also a higher level of pacing for these, although there's still a relatively small amount on the books. But in general, those top performing properties are booking earlier. So if you're looking at your booking trends and you're finding, hey, everything is just much shorter, there is an indicator there that you may need to make a change in strategy, because these top performing listings, they actually are booking a little earlier than the market. They're taking that market share, and it's probably contributing quite a bit to why they are a top performer. The next thing I like to look at is asking rates. So we're going to use this same trends table, and we're going to take a look at asking rates. And asking rates are the average rates that are being advertised in the marketplace. So we can kind of see how people are operating in the market and compare that to the occupancy. So January, February, where things were a little better or stable, probably a pretty good sign. People were posting a little higher rate, which we saw that the state of California expects in general, just higher rates overall. And we didn't see any attrition in occupancy. But as we get into March at the market level, we see kind of a mismatch. Occupancy dropped in the market, but the ADR position really didn't drop under last year. So people were not reacting very quickly to those drops in March. Now, some of that could have been the move of Easter, like I said before. Some of it could have been, Coachella and stuff like that, just how these events move around. But I would expect this in an environment where there's less occupancy available for everyone. I would expect this to be a little lower if the market was reacting really well. As we move forward from March forward, again, we're seeing this kind of consistent trend where the rate positions are consistently higher. And to me, what this says is that at a market level, there's that the property managers and the property people are pushing rates too high for the consumers. They are not quite optimizing the rate to where the consumer is actually going to buy, because we're seeing drops in occupancy, but we're not seeing similar reaction in the rate position. This is probably going to be driven by Easter and Coachella. It's a pretty big increase, but at the end of the day, that occupancy is barely stable. So, and there's a lot of vacancy in the market, which means a lot of people just didn't adjust their rate position at the right time. And at the end of the day, if you expect that you're going to need to drop your rate position to compete, you're going to want to do that a little earlier, because you won't drop as much. Two, you have an opportunity to undercut the competitors if they're dropping at the last minute. But if you all drop at the same time, the consumer has a lot of choice and it becomes a race to the bottom. Now, this May through August period, I think, is going to be, that's obviously the most critical period right now. And just looking at the fact that the market is pushing higher rates is a little bit of a concern. The market itself seems to be gambling that things are just going to be good in the short term. But that's a very risky gamble. And I think if you're a savvy revenue manager, you can start to make adjustments now all the way out through the summer. They're not going to be as big of adjustments as you would make in the short term, but you're actually competing with a lot less people because the market itself hasn't shifted that rate position down yet. Now, let's just take a look at the highest performance groups and see if we see a similar trend. Now, this is what's interesting to me. We do see a similar trend through Q1 all the way through April. We see those really high April rates, although we do know that in the highest performing groups that they were performing better, so they were able to command that higher rate better. We do see that in March, not quite the reaction that we would expect, but the highest performing listings have already made some shifts in their strategy that are accommodating what I've said. You can see here as we look from May through September, we know the May pacing looks a little better in the high performance groups, so we're still seeing a little higher rate. But when we get into June, July, and August, the market averages for the highest performing listings is actually already starting to undercut their historical posted rates a little bit. That means the top performing listings are reacting earlier to pressure on demand. And if you aren't currently doing that, if you're not looking out more than 30 days, more than 60 days, you may be missing the mark and putting yourself in a position where you have to compete with a lot of other people who are vacant. And these top performing listings will have already gotten stuff on the books, and it'll be at a little higher rate than where that rate cuts to at the last minute. The next piece I want to just dig in a little is that April position. So if I go to our historical graph, I can see these KPIs at the daily level, and I'm just going to zoom in on April. If you recall, we saw that April pricing was quite a bit higher year over year, which is good. But the occupancy situation was a little mixed. The highest performing groups performed much better, whereas the low performing, or the kind of market average, you saw a little bit of not really attrition, but you didn't see the big increases that kind of go along with that justify big rate increases. Now, what I'm looking at here is just the average nightly rates, and we're looking at it at the daily basis, and you can see there's really three main big spikes, including Coachella, across the market that are driving this. And so you have this first weekend of the 12th, you have the Easter weekend of the 18th, and then you have the weekend of the 25th, all driving substantially higher rates than last year, both across the medium and the high performance segment. When we look at the occupancy situations, and let me zoom in again, you do see overall increases in occupancy. So those higher rates and those demand periods really did justify the higher rate position. You see that they're pretty significantly occupied. When we switch to the highest performing groups, we see a similar trend here where even more of that business is on the books for those key dates. So really Coachella and Easter did a lot better this year. Where are we seeing the loss then, or where are we seeing that piece that, you know, kind of makes the top level seem like it didn't quite match up? It's occurring earlier in the year, or earlier in April. Pretty substantial decreases from the end of March up until those dates. And that kind of limits, like, it's a good thing that a lot of this business came in at the end of the month, because you can see here big drops in weekday occupancy, little bit of drops in weekend occupancy, and it really mitigated the growth potential for April to really make up for any losses that were occurring in March. When we look at that at the average nightly rate perspective, and let's just bring this up here, you see a similar trend here where not only was there loss, well, actually, you kind of see a reverse. Even though we had losses in occupancy, you can see at the market level that people didn't really adjust their ADR position. In fact, they kept it much higher, because in purple is this year and in green is last year. So what that indicates to me is that at the market level, people just were not reacting very quickly in March and April to changing market conditions. And to some degree, the performance over Coachella and Easter may have masked the fact that early April was operating fairly weak. That's a really big key point, where when we look at performance insights that we're giving access to everyone for, that would allow you to really easily see that. So instead of just looking and saying, hey, April looks like it's pacing well, you would see, well, hey, weeks 2, 3, and 4 are pacing really well, but the first 10 days of April are pacing really poorly, and really give you an opportunity to beat the market at a much more granular level. Again, I won't be pulling up these performance insights because they're really portfolio based on this call. But if you'd like to learn how to use these, let us know. We'll get you access to them for free, and you can use it to start optimizing better than the market is doing in this zone where occupancy was lower, rates remained higher, it gets masked by the fact that these event dates really did perform fairly well at market level. Okay, so next thing I'm going to do is I'm going to go into some of our sets data. So sets data is a way for us to build kind of market reports for more specific areas than the entirety of the market that Wheelhouse is tracking. So I have here a set for Palm Springs and Coachella Valley. I have filtered this down a little bit. I've filtered this down to listings that were open for the majority of the year last year and also were at least 50% occupied. So I'm trying to filter out some of the lowest performing listings so that we can really see how these listings are doing year over year. When I go to the trends section, I can see that same occupancy breakdown for this group of listings. And really what I'm looking for are the trends similar, or are we seeing big differences? So that top level market report is really quite similar to what we're seeing in just Palm Springs and Coachella Valley. It's really driving a lot of it. We have a stronger January, a pretty similar February, attrition in March, a little bit of attrition in April here. It didn't quite maintain as well as the market level as a whole. We have decent pacing for May, but maybe not great, and pretty low pacing coming into June and July. So again, when we look at the asking rates for these, the question is, are people just pushing their rate too much? Especially as we get out into these shoulder seasons, June, July, August, the market rate across this list of about 1,400 listings, still posting pretty high compared to where these rates ended up last year. And at the end of the day, that means there's opportunity, especially if you're seeing pacing problems in your portfolio or you're concerned there's going to be pacing problems in the market. Especially if you have that concern or you're seeing it now, you want to get ahead of it and start really making smaller adjustments much earlier out, because at the end of the day, if everyone's going to be competing in the short booking window, any occupancy you have on the books already is going to be a huge boon. Just one final piece here. I brought this down to the daily level, and we can kind of see the same thing I've been saying. That Coachella and Easter weekend did very, very well, likely masked the fact that really all of March and early April was down from an occupancy perspective. And when we looked at those rate situations, the market itself was not reacting. Now, it's okay here because that did really well. But you can see that this purple line continues to be ahead all the way through March and April, despite the fact that this group is losing ground in March. Again, extrapolate that forward. We see the same trend here where the market is just pricing higher than what they did last year. That's a big risk if you think things are going to get worse or you're seeing things are not quite pacing the way you'd like to see in your portfolio currently. Getting ahead of that now is going to be a huge boon. Now for the final piece, I want to look at another set. So this is another set that we've created for Joshua Tree. And Joshua Tree, you can see here, I'm just separating a little bit, and we're going to take a look and see if these trends look a little different. So I'm going to go over here to the Trends tab, and we can see that we're still primarily seeing this Q1 high season. Similar trend here, January, February, a little bit stronger. We're really seeing the same things. Drops in March, maintenance in April. May looks a little stronger here from a pacing perspective. June and July and August are pretty weak. Now, we'd expect in the desert that these are going to be weaker seasons. One other thing to point out is that overall the occupancy is lower in this group here. So we're not quite seeing the same occupancy level as in Palm Springs. But generally speaking, similar trends. So everything I've said before about, the market has indications that it really didn't adjust well for March and April, early April at least. And then we're seeing that same trend where it's likely the market is overpriced further out. It just means that you need to get ahead of that, especially when we take into account the fact that we're expecting international travel to continue to be weak, if that's a big segment of your portfolio, that the state of California is expecting some declines in domestic travel. We know that there's been a lot of financial news in the news that causes consumers to tighten up. It just means that you want, from a strategy perspective, you want to try to put your best foot forward as early as you can now, because if you get stuck competing in the last minute, that's where the biggest risk that things become a race to the bottom occurs. Now, some of you, if you're really, really savvy as well, and you're looking at this pricing asking rates chart, you may even go as far as to start making adjustments in the fall, especially in Palm Springs and Joshua Tree. When we look in Palm Springs, these are staying a lot tighter to where things are. So there's a little less room, but it means that the market is already kind of anticipating some adjustments. But any early booking you're going to get, especially in these lower occupancy time periods, is going to benefit you at the end of the day. Just thinking further out in periods where things are unstable is going to be helpful. When we look at Joshua Tree, this is actually much, much worse from a pricing perspective. What this really shows to me is that the market isn't really pricing competitively. They're not trying to price competitively this far out. But if you have segments of visitors who aren't going to show up this year, you really need to capture anyone who's looking now. And there are going to be some people looking now. And again, that last piece of advice is make some adjustments and do some rate experiments through the summer, because the market seems not super well optimized to the consumer. If you really are savvy, start doing that in the fall too. Get those early bookings. You're going to feel better if things get worse and you have stuff on the books. If you decide that you undersold a little bit, that's going to be more palatable than being vacant. Okay, so I hope you found that market data and market analysis really helpful for you. Those short kind of bullet points are early signals would have been good. It would have been hard to make changes. The market didn't really react to some of the pressure it was seeing in the spring, particularly March and early April. Late April was really strong with Coachella and Easter, and that may have masked some of the pressure in early April. And there's a little bit of a question mark whether that pressure is going to continue from May and on, June and on and so forth. At the end of the day, though, we do see at a market level that prices are still a little bit high at the market level compared to last year, especially if there is occupancy pressure. The state of California expects occupancy pressure, and that may filter down to Palm Springs. We also know that international travel is really damaged. So there's really some opportunities for revenue managers who start thinking further ahead to try to pack a little bit more occupancy on early by being more competitive with the rate. And you still have space at the market level between dipping under last year and where the rate currently is. So cutting the rate may not mean going below last year. It just means finding that sweet spot that's probably more stable with last year and at least starting there. Now, the missing piece here to compare to the market data is what is going on in your portfolio. I can't answer that for you. And you know what? You might not be able to answer it as well. If that's the case, or you'd like to get some more insights or like to get an expert opinion on what they're seeing in your own data, Wheelhouse is offering our Wheelhouse Performance Insights for free. If you sign up with Wheelhouse, link your account. You do not have to be paying for us as a pricing customer, but we will give you access to your data so you can see things like what your occupancy is by month, how that compares to where you were last year, so you can very easily see where you're pacing. If you have a situation like April, you can bring this down to the daily level, zoom in, and see exactly what dates and days are pacing ahead and which days are pacing behind, really giving you the opportunity to fine-tune where you make your rate adjustments. So, if you were looking at that April and Coachella was doing really well, Easter was doing really well, you didn't notice that early April was actually really weak, that's a missed opportunity. A view like this, where you can see this at the daily level, will give you the opportunity to make those minor adjustments while still capturing all of the strong dates that are driving revenue. Now, we understand that this is pretty complicated, so we are offering free consultations to teach you how to use this. We will also teach you a process to use this on a regular basis, so that if you have limited time, you can spend maybe an hour a week, hour every other week, and really keep an eye on your revenue management and be able to make impactful changes. If you'd like one of those consultations, let us know. We'd love to set up some time with you and get you ready to tackle the rest of the year. Thanks, and let us know if you found this helpful, and I hope you have a great day. Bye.